This is Captain Pierce. Welcome back to SkiesCapital. For the last 18 months, UnitedHealth hasn't been flying through clear skies. This has been a company navigating turbulence on nearly every front. A CEO departure, suspended guidance, a DOJ criminal investigation, a cyber attack that cost nearly $800 million to clean up, a medical cost ratio that climbed from the low 80s to nearly 90%, and a stock that lost more than 45% of its value in a single year. By the time we came into this quarter, investors weren't asking whether the flight plan looked good. They were asking whether the aircraft was still stable at all. Then, UnitedHealth reported Q1 earnings, and for the first time in a long time, the dashboard lit up green. The medical cost ratio came in far better than feared. Earnings beat, revenue beat, guidance was raised, and the stock moved sharply higher. So today, we're going to walk the cockpit together. We'll break down the three things that went right, the three warning lights still blinking, what the ROIC picture looks like versus peers, and what all of this means for the investment thesis going forward. UnitedHealth may not be fully out of turbulence yet, but this quarter did something important. It cleared the runway. Let's go. Let's start with the raw numbers. This is the scorecard. Adjusted EPS came in at $7.23. Wall Street was expecting $6.57. That's a 66-cent beat, about 10% above consensus. For a company that missed estimates twice in the last 4 quarters, that matters. That's not background noise. That's a meaningful change in altitude. Revenue came in at $111.7 billion versus expectations around $109.6 billion. That's about a $2 billion top-line beat. And this wasn't just one engine carrying the aircraft. The strength showed up across the business. Now, here's the number that mattered most going into this morning, the medical benefit ratio. UNH reported 83.9%. Some analysts were modeling numbers as high as 85.7%. The market feared worse. So 83.9% wasn't just a beat. It came in about 180 basis points better than that bearish estimate. That is the key gauge in this report, because if that number is stabilizing, the recovery story stays airborne. And then there's guidance. Management raised full-year adjusted EPS guidance to greater than $18.25 per share, up from greater than $17.75. They didn't hedge. They didn't hold altitude. They climbed. That's a 50-cent raise after 2 straight quarters of real shocks. One that sent the stock down roughly 22% and another that knocked it down about 20%. When management raises guidance after that kind of turbulence, they're telling you the flight plan is improving. Full-year revenue guidance was maintained at greater than $439 billion, which reflects the deliberate member contraction already underway. So when you step back, this was a clean sweep across the 4 gauges that mattered most. EPS beat, revenue beat, medical ratio beat, guidance raised. That's why the market reacted the way it did. Now, let's look under the cowling and talk about why. 3 green lights on the instrument panel. Let's go through them one by one. Number 1, the medical benefit ratio. This is the single most important gauge on UnitedHealth's panel right now. It tells you how much of every premium dollar is going back out the door to pay claims. And for the company, lower is better. Over the last 2 years, that gauge had been moving in the wrong direction. By 2025, the full year ratio was sitting at nearly 89%. That was a major jump in a very short period of time. And it is what broke the earnings story. But this quarter, that number came in at 83.9%. And that tells you a lot. It tells you the repricing strategy is starting to work. It tells you the exit from unprofitable Medicare Advantage markets is helping clean up the cost profile. And it suggests the utilization environment, which had been running much hotter than expected, may finally be starting to stabilize. Now, this is not an all clear. The warning light is not off. But for the first time in a while, management looks like it has this issue back under control. Number 2, the EPS beat and the guidance raise. I already gave you the raw numbers, but the real story here is what they mean. UnitedHealth used to be one of the most predictable companies in the entire S&P 500. For years, this was a business investors trusted to fly straight and hit its marks quarter after quarter. That changed in 2025. When that predictability broke, the damage was not just financial, it was reputational. The market stopped trusting the flight instruments. So, when management raises guidance today, that matters. This is not just a number, it is a signal. Stephen Hemsley came back into the left seat after the witty departure, and by raising guidance, he is putting his own credibility on the line. He is telling the market the recovery is real, and he is willing to back that up with a forecast. That matters. Number 3, broad strength across the business. This quarter was not just one division carrying the flight. UnitedHealth delivered strong revenue. Optum also came in better than feared, and that is important because the bull thesis on UNH has always depended on the integrated model, the insurance side and the healthcare services side working together. Optum, in particular, was where the story really came apart in 2025. That was the segment that went from a major profit engine to a major problem. So seeing improvement there now matters. It suggests the worst of that collapse may be behind them. Operating margin also improved, 6.6% versus 6.2% a year ago. Not a huge jump, but directionally, it is exactly what you want to see. So step back and look at the panel. Green light number 1, medical costs came in better than feared. Green light number 2, earnings beat and guidance went up. Green light number 3, the business delivered broader strength, not just a one-line beat. That is why this quarter mattered. Now let's talk about what is still flashing yellow. One good quarter does not clear every warning light on the panel. There are still 3 things on my radar. Number 1, the DOJ investigation. This is still open, still unresolved, and still the biggest non-operating risk hanging over the stock. The Department of Justice is looking at UnitedHealth's Medicare billing practices through both criminal and civil investigations. At the center of it is a simple question. Did the company overstate patient diagnoses during in-home assessments in a way that led to higher government reimbursements? So far, there have been no charges, no settlement, and no clear timeline for resolution. And management has not put a number around the potential exposure. That makes this the biggest unknown in the story because it doesn't matter how clean the quarter looks operationally. If a major DOJ headline hits, it can reset the entire investment case in one day. So this stays on the checklist. No question. Number 2, membership contraction. Management has already told the market that 2026 will include a deliberate exit from unprofitable contracts. Strategically, that makes sense. If you are carrying high-cost, underpriced business, the right move is to walk away and clean up the book. That is disciplined underwriting, but there is a trade-off. This is also the kind of decision that can make the numbers look better while making the growth profile look weaker. And for a company like UnitedHealth, one that built its identity around scale, consistency, and expansion, that matters. So the question is not whether membership is declining. We know that. The question is whether that decline stays controlled and intentional or starts to run ahead of plan. If it stays orderly, fine. If it accelerates, that tells you something deeper may still be wrong. Number 3, cash flow. This one is not a flashing red light, but it is absolutely worth monitoring. Full-year operating cash flow is guided at greater than $18 billion, down from $19.7 billion in 2025. That means cash generation is still solid, but it is stepping down. Now, maybe that is just timing. Maybe it reflects restructuring friction, transition costs, or ordinary working capital movement. But it is also possible that part of the improvement we saw this quarter, especially in the medical ratio, reflects claims timing rather than a fully permanent cost improvement. I am not sounding the alarm here, but I am watching it carefully. So step back and look at the panel. The quarter was clearly better. The thesis is improving, but 3 warning lights are still on. DOJ overhang, membership contraction, cash flow durability. Now let's put the capital picture in context, because ROIC tells you whether this business is actually creating value. Return on invested capital is my quality anchor for any business, because at the end of the day, this is the question that matters. Is the company actually earning more on its capital than it costs to put that capital to work? That is what ROIC tells you. And when you compare it to WACC, the weighted average cost of capital, you get a simple test for value creation. If ROIC is above WACC, the company is creating value. If it falls below, it is destroying it. That is why this matters. Now let's look at the flight path for UnitedHealth over the last 6 years. Back in 2020, ROIC was about 14.5%. In 2021, it improved to 16.2%. In 2022, it peaked around 17.1%. That was the golden altitude. The integrated model was working. Medicare Advantage was growing profitably. Optum was still compounding at strong returns. And when a business this large is earning 17% on invested capital, that is exceptional. Then came the descent. By 2024, ROIC had fallen to about 14.9%, and in 2025, it dropped to roughly 8.3%. That is a dramatic loss of altitude. Why? Because the earnings engine weakened while the capital base kept expanding. You had the Medicare Advantage utilization shock, you had Optum losses, you had restructuring charges. All of that pressured returns. At the same time, invested capital kept building. Now, even at 8.3%, UNH is still above its estimated cost of capital. If you put WACC at roughly 4.6%, the spread is still positive. That means the company is still creating value, but the spread is much thinner than it used to be. And that is the key point. UnitedHealth is still above stall speed, but it is nowhere near the altitude it once had. That is why the recovery thesis matters. The bull case is not just that earnings stabilize. The bull case is that ROIC climbs back toward that 14% to 17% range over time. And this morning's quarter helps. It is a step in the right direction. It suggests the aircraft may be stabilizing, but one quarter does not rebuild a return profile. That takes repeated execution, quarter after quarter, year after year. So yes, today was encouraging, but if you really want to know whether this business is fully recovered, watch the ROIC spread, because that tells you whether UnitedHealth is just surviving the turbulence or actually climbing back to cruise altitude. Now let's put that 8.3% ROIC in pure context, because a number by itself does not tell you much. You need to know where it sits in the formation. Elevance Health is around 9.2%. Cigna is about 6.1%. CVS is roughly 6.2%. And Humana is down near 2.1%, which puts it below its cost of capital, meaning it is destroying value right now. So where does that leave UnitedHealth? Right in the middle of the pack. And on the surface, that does not sound terrible, but context matters, because UnitedHealth did not used to be a middle of the pack operator. It used to be the clear leader. Back in 2022, UNH was earning about 17.1% ROIC. Elevance was closer to 11%. That is a massive gap. UnitedHealth had roughly a 6-point ROIC advantage over its nearest peer. That is real separation. That is leadership altitude, and that advantage is gone. Today, Elevance leads the group. UnitedHealth is still near the front, but the spacing is much tighter than it used to be. And that matters because the premium valuation UNH commanded for years was built on exactly that kind of leadership. The market gave UnitedHealth a premium multiple because it earned it through higher returns, stronger execution, and better capital efficiency than the rest of the field. So if you are buying the stock today, that is really the bet you are making. Not just that the business stabilizes, not just that the next quarter looks better. The bet is that UnitedHealth can reclaim leadership, because restoring that ROIC edge is what justifies a premium multiple again. And until that happens, the stock may be improving, but the old flight ceiling has not been restored. So where does the investment thesis stand after Q1 2026? Thesis status, improving, but with one major open variable still hanging over the flight path. Here is what this quarter proved. First, the medical ratio repricing appears to be working. That was the most important gauge on the panel, and this quarter it came in better than feared. Second, management was confident enough to raise guidance, not hedge it, not leave it alone, but raise it. Third, the business delivered broader strength. This was not just one clean headline number. The operation performed better across the board, and the market noticed. As I'm recording this, the stock is sharply higher. That tells you investors were positioned for bad news, and they did not get it. Now, here is what still needs watching. The DOJ investigation is still the one issue that can change this thesis overnight. I cannot stress that enough. Membership contraction has to stay controlled and intentional, not accelerate beyond plan. The cash flow step down needs to prove it is temporary, tied to transition and timing, not the start of something deeper. And ROIC, now down around 8.3%, needs to start climbing back toward the mid-teens over the next several years if this business is going to reclaim its old altitude. Now, here is what would break the thesis: a serious DOJ escalation, medical costs turning back up and wiping out this quarter's progress, a downward revision to guidance, or membership attrition running materially ahead of management's plan. None of that happened today. In fact, today gave us the opposite. It gave us evidence that the business is stabilizing, that management has more confidence, and that the market may have become too pessimistic. So my conclusion is simple. This thesis is improving, but it is not repaired. The aircraft is more stable, but it is not yet back at cruise altitude. Here's the final approach on UNHQ 12026. The MCR came in better than feared. Guidance was raised, not hedged. Both business segments delivered. 3 green lights, and the market is responding to them appropriately. But the DOJ is still sitting in the pattern. Members are still leaving, and cash flow coverage has stepped down. 3 things that stay on your checklist until they're resolved. Thesis status is improving. The plane is off the ground. The question now is whether the flight plan holds. Watch Q2 MCR, watch DOJ headlines, watch whether the membership exit stays orderly. As always, think clearly, invest better. I'm Captain Pierce. This is SkiesCapital. If this was useful, drop a like and subscribe. I'll see you next flight. Captions log out.